Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And this is actually going to be the first part in a four-part series of in a video series called Loss Limitations. And so what we're going to, really kind of the genesis of all of this is I'm a professor at a university. I have students. They tend to get a little bit confused with some of these loss limitations, but more importantly, I also have clients. And we've had some clients where we've actually delivered tax returns to them in the past, and I'm talking like over the past few years. And there's sort of an expectations gap between some of the losses that they anticipated on some of these tax returns that they were doing versus the actual losses that they were actually able to take. And so what ended up happening is we got past that, and I said, hey, look, I just think that I had to make a video series in order to be able to talk a little bit about some of these loss limitations, help my clients, help my students, and that's kind of sort of the whole theory on Tax Academy anyways. And so when we're talking about loss limitations, I have what I like to refer to as the three buckets. And so the three buckets, as you'll see here, there's basis limitations, risk limitations, and passive limitations. And why we call it the three buckets, actually, this is sort of, actually, I call it the three buckets, actually the three leaky buckets. And so the three leaky buckets, as we have, there is actually another video series where we can talk about the three buckets, but that's dealing with something else. But, the three buckets that we're talking about here are basis limitations, at-risk limitations, and passive limitations. And the reason why we call them the leaky buckets is if you have sufficient basis in your entity that you're dealing with, it allows you to take a basis limitation on this, past the basis limitation, it leaks out into the risk limitations. And then if you have sufficient risk in the activity, then it leaks out to the passive limitations. And so this is kind of the thing that we end up talking with our clients about all the time. Now, a frustrating thing when I first got into the industry is I didn't think CPAs were spending enough time really educating the clientele and the public in general about a lot of this stuff. And so when I started looking at some of this, I never understood why. Why is it the CPAs aren't talking to people about it? Now that I've done tax returns as my own practice for many years, I've kind of come to the understanding of why this happens. And that's because when I hand my tax return to a client and say, look, you're not getting a loss and here's why, they don't want to know about all three of these. All three of these were played and important in their activities that were taking place, but they didn't need to know about all of this. I go to them and I'm like, no, you have an at-risk limitation as a result of which you can't take a loss, or you have a passive limitation as a result of which you can't take a loss this year. But I think there's a lot of misunderstandings about it. There's misunderstandings about the fact that they think, well, that means that these losses must be gone. That's not the case. The losses aren't gone. They're just suspended, and we'll talk about that as it happens. But again, like I said, we start off with the basis limitations. If you have sufficient basis, it goes to the risk limitation. If you have sufficient risk, it goes to the passive limitations, and it kind of comes up. And now, where I came up with this three leaky bucket metaphor was actually, I used to start, when I first started teaching, I taught at business associations. And so when I was trying to explain to people, and actually my favorite business association to teach at was the Realtor Association. And the realtors, one of the cool things I love about realtors come from all walks of life. I've had prior military people who have become realtors. I've had, prior people who used to be salespeople. I've had prior people who, did, they do IT for a living and they decide that they want to dive a little bit into the realtor business. So trying to explain something to a group of people that's as, not really as homogeneous as you can imagine. Like, for example, if I was going to explain this to lawyers, different way. I mean, lawyers, I could just propose this from the law. It's going to be an easy thing. But when you're talking about the wide berth of people who become realtors, it's really difficult to find something that really just kind of sticks with them. And this really worked. And so what I've done is I've gone ahead and I've said, okay, we're going to talk about this in the context of the three leaky buckets. And so that's where we've ended up bringing this stuff out. Now, I want to also talk about this before I end class, the context of this. We're talking about this in context of partnerships. Now, why would I choose partnerships when all these other entities could have it? S Corp, C Corps, and individuals. And part of the reason why is because the partnership is going to deal with all three of these regardless, okay? Every time the partnership has losses, it has to pass through these three leaky buckets. If it doesn't pass through the three leaky buckets, no loss, okay? So it's got to get passed here. S corporations Generally, you're going to have basis limitation issues that you're going to run into, passive limitation issues you're going to run into, but you're also going to, you may not have as much to do with at-risk limitation. Generally, at-risk is not a major issue when it comes to S-Corps. Can happen, generally not. Most of my S-Corps that I've ever dealt with, no at-risk limitations. There's other limitations, but not these two. And so there's that needs to happen. The next thing, of course, C corporations. C corporations will have these limitations, not so much for the entity itself, but sort of if you think about corporations stepping in the role like an individual. So if a C corporation owns a partnership interest, so say for example, they go into a joint venture to develop a plot of land, develop it into and put houses on it, and then rent those houses out. That is a potential area where C corporations could run into sort of the passive limitations and some basis and at-risk limitations, especially if they're getting involved with joint ventures or other types of partnerships. Individuals, generally what's going to happen with individuals, they won't have so much the basis limitation. When I say individuals, I get it. Most of the time, partners are individuals. But when I'm saying individuals, I'm talking in the context of Schedule C businesses and Schedule E entities, and Schedule E activities. But the Schedule C, what will end up happening is you generally won't have basis limitations. Basis limitations won't happen at that point. You could have some risk limitations. I have worked on a tax return where we did have some risk limitations as a result of a Schedule C activity, and then passive limitations where we kind of made a determination in many instances where there's a passive limitation. With individuals, generally you're going to see that on Schedule E entities, production of income, so things like rent, royalties, patent income, things of that nature, where there could be some passive limitations. This and rental activities, very common, where we run into where people have these passive loss limitations, and as a result of which they have to kind of step back and say, okay, fine, I get it. We'll deal with this as we have to. But again, we're going to talk about this in the context of partnerships, just because it kind of works out that way. But all of these different types of entities out there could very well easily have these kind of limitations that take place. So anyways, that's all I've got for the intro video. I want to say thank you very much for coming to class. Remember, my name is Kevin Matthews. I am the tax professor. This is the Tax Academy. Class is always in session because the learning never stops. We're looking forward to keeping you around, and hopefully you get a lot out of it. If you like this video, please go ahead and hit the like button on there. And then if you like the video series and you want to keep learning more about it, especially as we do more of our YouTube live sessions, please feel free to go ahead and hit the subscribe button so that we can keep you informed as to what's going on and how this stuff all works out. Again, we are very happy to have you here, and thank you very much.